Hello, and welcome to Ward 13 with Jon Hopwood.
Yeah, this is Jeff Kassel.
Jeff, how are you doing, my friend?
I'm fine. I'm home. Were you talking about banking on your show?
Yes, I called in. You don't mind Gonzo, do you? We did Gonzo's art, and you're welcome to join in. It seems like I was talking to my friend in California, and she's European. She was talking about the imminent failure of Credit Suisse, and that's roiling the markets in Europe. Can you describe what's going on now, and how that's going to affect me, Gonzo, and the rest of the people?
It's not going to affect you at all.
It's not.
But there are some other things that will affect
What about
depositors.
what about Silicon Valley Bank?
Not depositors, but stockholders and bondholders of bank. Credit Suisse is that's a European bank. They probably have offices here in the United States and do business here. But so far, there are problems, but I don't think it's a fatal problem. It's hard to say because banks are basically black boxes. Very few people know what's going on inside the bank, what assets they hold, what loans are going bad, and how much cash they have on hand, which they refer to as liquidity. That was the problem with Silicon Valley Bank, which just went under, along with another bank which went under Sunday. They had Silicon Valley Bank had around $210 billion in loans.
Loans, okay.
And $175 billion in deposits. At least that was the number around the end of 2022. But they didn't have enough cash on hand, and they tried to sell part of their loan portfolio, which they called an asset. And these were, I think, treasuries and mortgage-backed securities, but they had low yields because they were older. They bought them prior to 2022. So if you remember, the yields on treasuries and mortgage-backed securities dropped quite a bit because the Fed was engaging in QE, which is basically inventing money to buy these kinds of bonds to drive the rate down. And they were trying to drive the rate down. So
qualitative easing? Is that what it's called? Qualitative easing?
Quantitative easing, QE.
Yeah. Okay.
And basically, it's inventing money where it wasn't before, and using that money to buy low-yield treasuries and low-yield mortgage-backed securities. And they wanted the yields to be low because, frankly, when you got $32 trillion of debt, as the United States has, we really can't afford to pay much above zero for interest. And that is the complicating problem here. The bank owned these low-yield securities but didn't have enough cash. I'm talking about Silicon Valley Bank.
Right.
So they sold some of those securities, about $20 billion worth, at a loss. And they booked an almost $2 billion loss because bonds, when the yield goes up, the price of the bond goes down. It's an inverse relationship, too complicated to go in here, but to go on to explain it here. But they lost about $2 billion in the transaction. Goldman apparently bought those bonds, and then within days, yields dropped, so maybe Goldman sold them at a profit. Who knows?
Yeah.
No, people aren't disclosing fully the information that went on. But what's important to understand is this is a pretty big bank, Silicon Valley Bank, with, it's a $200 billion bank, so it's not a small bank. And they had a lot of clients, and they had a lot of depositors. For example, Roku, which is a TV streaming service, had almost $500 million in that bank in cash.
In cash, okay.
And that represented a quarter of their liquidity, their cash. And they're not insured. They're only insured up to $250,000 by the FDIC. So if the bank goes into receivership, all of the assets of the bank are sold, and what's ever left goes to the big depositors. So they would take some kind of a haircut. If they had, let's say they had $1 billion worth of cash in the bank, maybe they would recover 800 million. They would take a haircut, but they'd get something.
What's the
But that's
status
not
of
what
the?
happened.
What's the status of the?
FDIC insured everybody, whether they
Fully?
were covered by the $250,000 limit or not. So basically, what happened, and this is why the government is being criticized, is they bailed out wealthy depositors and corporate clients fully, so they didn't have to take a haircut. And
No risk,
we
in
saw
other
something
words.
almost similar to that back in 2008, when there was a bailout of banks that were considered too big to fail, like Citibank. Even Goldman needed to borrow money because they had cash problems. They couldn't meet withdrawals or rollovers or whatever was how. They needed more cash. So they borrowed $10 billion from the U.S. government, which they paid back with interest, and they also borrowed $5 billion from Warren Buffett. So Goldman Sachs was insolvent, at least temporarily, and they needed bridge loans, and they eventually paid everything back and were quite profitable. Now, the reason all of this is important is that Silicon Valley Bank is not the only bank that's holding low-yield treasuries and mortgage-backed securities. We don't know how many banks are in that kind of shape.
Yeah.
So that means they have to have a lot of excess cash in case there's a run on the bank. There was a run on the Silicon Valley Bank, and some of the big depositors with millions of dollars in the bank demanded their money back, and finally. The bank no longer had any cash left. They couldn't meet the withdrawal request, and they were declared insolvent. The stockholders and the bondholders in the bank lost everything. But every single depositor, regardless of how big the deposit was, even if it was $500 million, was covered. FDIC insured that.
So it was bailed. It was a bailout.
Assets, and they'll recover most of the money when they sell the assets.
Yeah.
They can't seem to find a buyer for the bank. This is what happened when Lehman went down in 2008. They tried to find a buyer for Lehman, and they couldn't find one. And there were all kinds of domino effects when Lehman, couldn't meet their financial commitments. They couldn't pay interest on debt that they owed, and finally Lehman imploded, and
didn't that trigger?
Bank imploded, and a number of Washington Mutual imploded. That was the biggest bank failure. But actually, there were bank failures that were prevented by taxpayers when they loaned maybe $500 billion to banks and insurance companies in 2008 during the Great Recession.
So is there going to... Okay, but is this... What's the effect of this? Is it going to be like a Lehman Brothers, or is
Nobody knows.
SVB not that critical?
Nobody knows, but I'll tell you, today Bank of America lost 5% in the stock market.
Really?
And Goldman Sachs, I think, lost the same or even more. And nobody knows how many banks are in the same position. So the regulators who regulate these banks, who actually have access to the books and know what's going on inside the banks, are probably going to make sure they have greater reserves, which means they're going to lend less money. It also limits the amount of interest they can pay on a savings account. So you can buy a 6-month treasury a week ago that paid 5%. But if you go to your local bank, they're not going to give you 5% on your deposit.
Right.
They're going I think the most they give you is 2 or 3%, and so the banks are not really a good place to keep money. You're much better off buying U.S. Treasuries because that's guaranteed. You will always get your money back, even if the Fed has to print the money to make sure you get your money back and get your interest on the loan. For the duration of the bond until its expiration date, in which case you get all your principal back. The real danger is how many banks are in this problem, and what it's going to cost. This was a bailout. There's no question about it. But they bailed out depositors, and they bailed out big depositors that were not insured. Only 250,000 was insured in every bank, and so that was new. And they're getting a lot of criticism for it. and a lot of politicians are talking about who's at fault, but in the end, it was the bank managers themselves who were at fault. They didn't have sufficient cash, and so when they tried to raise it and took an almost $2 billion loss selling old treasuries, which were underwater, they were upside down in them. That raised some anxiety in the minds of big depositors, and they started withdrawing the money, and that caused the bank run, which caused the ultimate failure of Silicon Valley Bank.
Yeah,
now does the average person have to worry about it?
Right, that's the question.
I got money in Bank of America and in TD Bank here in Manchester, New Hampshire.
Right.
And I'm actually thinking of taking my money out of TD Bank. Even though it's a couple of blocks from my house, I don't know how big they are. I don't know what their liquidity is, and I will never know.
Well, it is a national,
you have to understand,
an international bank.
2008 to 2009, I think something like 400 or 500 banks went under.
Yeah.
So it was a pretty serious problem, and I don't know exactly why they went under. I think a lot of it had to do with bad real estate loans, and we have commercial loan problems now in the United States. Most people don't, think too much about that, but people that buy office space and apartment buildings think about it. And for example, New York City, their commercial space is about 25% vacant.
Yeah.
So there's no income coming in for the people that own those buildings, and they got loans to pay because most real estate people try to borrow all the money they can, so they don't have personal money, in the transaction. So when you've got vacancy rates of 25%, that's a serious problem.
TD Bank's $430 billion in assets.
Okay, so it's about twice as big as Silicon Valley Bank. And the other thing about Silicon Valley Bank is they had a lot of venture capital deposited in that bank. I heard Mark Cuban had millions of dollars there. And I don't think TD Bank is like that. And TD Bank, I think, is a Canadian bank. They didn't have the problems that we had in the United States. Canada, but who knows? You see, these banks are black boxes. The only people that have access to the books are the regulators. And in this case, in the case of Silicon Valley Bank, the regulators didn't act. So, or maybe they couldn't act fast enough. And there was a run on the bank because of some bad publicity. They had to declare that $1.8 billion loss, almost $2 billion, when they sold their securities to raise cash, and that caused an even greater run on the bank. And
Jeff, we only have 5 minutes. We only have 5 minutes.
Okay, well, I'm done if you're done.
Yeah, TD Bank is a top 10 bank. But it's $430 billion assets, really pales in comparison to somebody like J.P. Morgan Chase, which has over $3 trillion, and Bank of America, which has $2.5 trillion. Is there going to be? Do you think there's going to be eventually like a consolidation in the banking industry, as everybody flees to?
That's been going on for years, but these big banks are too big, and they're too big to fail, which means.
Right.
Which means ultimately the taxpayers are going to have to bail them out if there's a systemic collapse in banking. This is what happened during the Great Depression when we lost 40% of our banks.
Yeah.
And they finally just shut the banks down to try to stop the runs on the banks. And that's when FDIC insurance came into being, so people would have confidence. But FDIC insurance is basically a lie. If you have serious problems in banking, FDIC doesn't have the money to bail every depositor out. They don't have the money.
But the federal government does. The federal government.
No, government has no money. The government gets money from taxpayers, or they borrow money. And that's what happened in 2008. They borrowed something like $700 or $800 billion. And they bailed out banks, they bailed out car companies, and they bailed out insurance companies that went under. This was unprecedented, and they broke all the rules. I mean, in capitalism, you must allow companies to fail.
Yes.
It's called creative destruction, and then new companies buy the assets at fire sale prices, and the new organization is solvent. That's the way it's supposed to work. But you see, in our system, the big guys, the Wall Street guys, and the Fed is very much a tool of Wall Street. They take care of Wall Street, and they make sure that Wall Street's okay, and that's exactly what happened at Silicon Valley Bank.
Yep.
The big depositors should have taken a haircut, but they didn't. They're only insured at $250,000, but now they've indemnified everybody. If you had $1 trillion in a bank, you're indemnified by FDIC, even though they don't have $1 trillion.
So the
government will have to go into the bond markets and raise $1 trillion. That's what I'm saying.
So it was all shifted onto the taxpayer.
Well, ultimately, the taxpayer is going to bear the brunt. Well, I mean, that's what inflation is. Inflation is a tax on every person living in the United States.
That's true.
And this is another consequence of running interest rates down to zero. And who wants to buy a treasury bond at an interest rate near zero? Nobody. But the banks have to put their money somewhere, so they bought safe treasuries and got stuck with a low-yielding bond.
Right, and now the Treasury...
Valley Bank, they had to sell to raise cash, and they sold it at a loss.
Okay, Jeff, we have to go now. I hope you come back in the future to explain just what you were talking about, because it seems like with the rates going up and the Treasury rates going up, there's going to be a lot more roiling in the banking markets or credit markets.
Well, maybe rates won't go up any further.
Oh,
who knows what the Fed is going to do? They were involved in these negotiations, and they broke precedent, and they insured every deposit in every bank in America. That's unprecedented. Okay, I'm done.
Okay, Jeff, thank you very much. Talk to you soon. Okay, folks, see you next week here. Hey, how are you? Take care. Bye.